This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now coming on to the risk management section of the syllabus. Foreign exchange risk management, and then later interest rate risk management, which is a really core area for the exam. The examiner's made it clear that in the exam there'll always be one question focusing in some way or another on discounted cash flow, albeit you've seen in the earlier lectures there are so many different things can be asked under that heading. But also there'll always be one question focusing on either foreign exchange risk management or interest rate risk management. In theory there could be both examined, but that'd be unusual. But it really is a core area. And foreign exchange risk management first. There's a lot to deal with. This lecture, well, this chapter will be split into several lectures, and then there's another chapter. So there's a lot to go through. But once you've got it, we can all make silly mistakes in the exam, but once you've understood it, it should be pretty easy to get pretty good marks. So it really is worth making the effort. Anyway, first of all, foreign exchange risk management. Part of this is revision from paper, well, the earlier straight financial management paper, where we did look at various things. What was asked there is asked again in this exam, and so I am going to repeat it. But this exam also goes further. There are extra things and extra arithmetic required. So let's make a start. First of all, this lecture, a nice gentle start. We're talking about, fairly obviously, trading abroad with another country that has a different currency. That's why we've got a risk involved. But be clear, little bit, just for little bits of discussive answers, of the types of risks that are involved if we are trading abroad. The three types: transaction risk, that in some ways is perhaps the most obvious of all, in that if we are, let's say, in a Euro country working in euros, if we buy something from America and get invoiced in dollars, then we're going to have to buy dollars. But the trouble is, whatever the exchange rate happens to be now, if we're not going to pay the invoice for, let's say, another month, then in a month's time, the exchange rate could have changed, and in euros it ends up costing us more or costing us less. But there is risk. Appreciate, risk isn't always bad. But if you're buying in dollars, sorry, if you're invoiced in dollars and our currency is euros, when you come to buy the euros to pay the bill, depending on the exchange rate movement, you may end up paying more, you may end up paying less. There is risk. And that's what we're really concerned about in the arithmetic that's following. The risk of exchange rate movements when we receive money or when we pay money. However, the other risks, the next one is what we call translation risk. What this is suppose we're a company based in a Euro country and working with euros, but maybe we have an investment in America where obviously they work in dollars. Well, when we come to prepare our accounts, we'll prepare our accounts obviously in euros. We're in a Euro country. But if we've got an asset in America, well, we need to take its dollar value and convert it to euros. And it can mean, obviously, that if this year the exchange rate is different than it was last year, then when we come to convert, The asset's value in euros may be higher or lower than it was last year. However, the increase or decrease in the value due to the exchange rate is really only a book figure. It affects the accounts, but we're only really affected in actual cash terms when we buy or sell anything, when we're actually paying or receiving money. Simply, the value in the statement of financial position going up or down isn't actually costing us any real money, if you understand me. And so although in financial accounts we may be worried about that, as far as the financial manager's concerned, they're really only concerned with the money side of it. Finally, what we call economic risk. I don't quite like what I've typed there directly, but still. What I mean by economic risk is that if ever you trade abroad, you're taking extra risks than if you were trading in your own country. If for no other reason than, for instance, it may be harder to collect cash from a bad customer. If you're selling goods abroad and the customer doesn't pay, it's clearly, depending on the country, that much harder to get your money back. Or, of course, economic risks in the sense of, depending on where it is you're buying or selling from, if their economy collapses, then it may have a big effect on the costs of whatever you're importing, or on the level of sales if you're exporting. So there are all risks involved in trading abroad, but what we're concerned about in this exam and in this and the next chapter is transaction risk. That we're going to pay $100,000 in a month's time, and whatever the exchange rate is at the moment, in a month's time it may be different. And we end up having to pay more or less, effectively, in our own currency. Okay, over the page, now nothing directly to do with risk yet, but is looking at the way exchange rates are quoted in the exam and how we deal with it. Because it's vital that you are able to convert the money properly, otherwise everything we do on risk becomes, well, not silly, but becomes even more difficult. And the point is that exchange rates, when exchange rates are quoted, they're normally quoted as a range. You can see there, I've given an example, a quote of $1 pound 1.6250 to 1.6310. Now, when exchange rates are quoted in this form, as they usually are in the exam, there's two things to make sure you're happy about. Forgetting the spread for the moment, I'll explain that obviously in a minute, but they're both about 1.6. If it's quoted like that, it always means this many, I'll say 1.6 for the minute, forget the spread, but that many of the first currency, which here, the first currency listed, is dollars, is equal to 1 of the second. The dollar is being quoted against the pound. So when we come to do any converting, if we've got pounds and we convert into dollars, every pound will result in $1.6. Or alternatively, if we've got dollars and we convert into pounds, it'll need $1.6 to convert to every pound. So that's the first, if you like, rule. The second is that normally we're given two rates rates as here, 1.6250 to 1.6310. And the reason for two rates, as I'm sure you're well aware, is the bank has to make a profit on foreign exchange dealings. When you buy or sell currencies through the bank, they use one rate, depending whether you're buying or selling, and the other rate for the other one. The difference is effectively the bank's profit. And it's desperately important you get sorted on, depending on which way we're converting and which currency we're converting, that you know which of the two rates to pick. Because when we do come later to dealing with all the risk management, if you've started off by picking the wrong rate, then everything goes wrong. You won't lose all the marks, you don't lose marks twice, but it's awful. You know, for everything to have started on the wrong figures. You've got to make sure you're clear which rate you're going to use. Now, how you remember which rate to use is entirely up to you. Some people look at it different ways. The way I remember it is this. We use the first rate, the lowest lower rate, if buying the first currency. And what I mean by first currency is the first one, the way it's quoted. So what I mean is here, the first of the two is dollars. If you're buying dollars, for my example, you'll use 1.6250 to convert. On the other hand, if we were converting the other way, if we were selling dollars in order to buy pounds, we use the higher rate, the second rate. The first quoted currency. Now, start again. If we want to convert dollars into pounds, so we're selling dollars to the bank or buying pounds. If we're selling dollars, then we'll use the higher rate. We'd use 1.6310. Now, I'll, in a sense, prove to you why in a second. But some people get awfully confused. They talk about the bank's buy rate, the bank's sell rate. Well, remember it any way you want, but here I'm not talking about the bank at all. It's us I'm worried about. If we are having to buy dollars, we've got pounds and we're buying dollars, we'll convert to 1.6250. If we have dollars and we want to convert to pounds, we'll be selling dollars, we use 1.6310. Let me show you what I mean and why and how you can make sure you get it right in example 1. Incidentally, I haven't typed, but in every question in these notes, unless I say differently, and I will say differently plenty of times, but unless I say differently, assume we are in the UK, and therefore we use pounds. So in example 1, A is in the UK, and we're receiving $100,000 from a customer in the US. And so, of course, we need to convert into pounds. The exchange rate is quoted $-pound, 1.6250 to 1.6310. The question is, how are we going to convert and which rate will we use? And these two separate things. The first is, remember that for getting the spread for the minute, it's about $1.6 converts to £1. And so if we're converting $100,000, well, if 1.6 converts to £1, we'll have to divide by the relevant rate to get the pound amount. The second is, which of those two rates am I going to use? Well, I'll remind you of the rule I gave you in a minute, but appreciate it's always going to be whichever's worse for us. It's the bank that makes profits out of this, having the two rates, not us. And so which of you give us worse? Surely, since we're dividing, the bigger number we divide by, the lower amount we'll end up with. We're receiving money, so it's whichever ends up giving us the smaller receipt. We divide by the bigger number. Or to keep thinking through like that in the exam is perhaps wasting too much time. My rule was, if we were buying dollars, we'd convert at the lower rate, dollars being the first currency. If we're selling dollars, we convert at the higher rate. Here we're receiving dollars. We want to convert to pounds, so we'll sell dollars to the bank and buy pounds. Therefore, we convert at the higher rate, and it converts to 100,000 divided by 1.6310. It converts to 61312. And in foreign exchange questions, normally it does expect you to do things to the nearest pound, nearest dollar, whatever it is. But there we are. And I'll say again, make sure you've got it. You know, either learn my rule or invent your own rule. I don't care as long as you get the right answer. But it is vital. And I know for some people it's confusing initially because in different countries they actually quote currencies different ways round than they do in the exam. In different countries they're written as sort of bank sells, bank buys, which confuses. But I've told you the rule I use. This is the way they quote. They're always quoting the first currency here, dollars. How many of the first currency are equal to 1 of the second here, pounds? All right, we're going to do one more because, although in most questions they tend to use what you might call real currencies, pounds, dollars, euros, which might make things in some ways easier because people have a feel, perhaps, depending on what you do at work, you might have a feel for what the exchange rates are. Occasionally, though, he invents invents currencies, where, of course, you have no feel for it at all. So, look at Jim Jam, example 2. It's the same rule. Jim Jam is a company based in India, where the currency is the Indian rupee. They owe money to a supplier in Ruritania, where the currency is Ruritanian dollars. So obviously the Indian rupee is a real currency. Ruritanian dollars clearly is invented. We're told the exchange rate, and the quote is given as Indian rupee to Ruritanian dollars as 8.6380 to 9.2530. And of course, even if you're watching from India, you've no idea, no feel for that exchange rate, because Ruritanian dollars don't exist. And bear in mind, we're in India. We owe Ruritanian dollars. We're going to have to pay Ruritanian dollars 240,000. And so we want to convert. Well, two things to be careful about. First of all, forgetting the spread, you know, the rates 8, 9, forget the spread for the minute. How are we going to convert? We want it in Indian rupees, and forget the spread for the minute, let's say 9. 9 rupees, 9 of the first is equal to 1 Ruritanian dollar. So every Ruritanian dollar will cost us somewhere around 9 rupees. So how many rupees will it cost for 240,000 Ruritanian dollars? If $1 costs us 9 rupees, 240,000, we're going to have to multiply by the exchange rate. Secondly, which of the two exchange rates are we going to use? Well, I'll check it two ways. Doesn't matter, I've said, how you remember in the exam. But I said that always, if you're buying the first currency, Indian rupees, you'll use the lower rate. If we, not the bank, if we are selling the first currency, Indian rupees, you'll use the higher rate. What are we doing here? Are we buying rupees or are we selling them? Well, since we have to pay, we're going to have to pay Ruritanian dollars. We'll have to buy Ruritanian dollars from the bank. And how are we going to get them? Well, in order to buy the dollars, we'll sell rupees. So buying dollars involves selling rupees. And the relevant rate for selling the first currency rupees is 9.2530. And so how many Indian rupees will it cost us? 240,000 times 9.2530. I get 2220,720. And is that logical? Think about it. As long as you're happy that we're going to have to multiply, because for every dollar it's costing around 9 rupees. But remember, we're paying out money. And it has to be whichever rate is worse off for us. It's the bank that makes the profits, not us. And of those two rates, surely, since we're multiplying by 9.2 will end up costing us more than if we'd chosen to multiply by 8.63. We'll pay 22.2 million rupees. Now, think about that, please, because I'll say again, arithmetically it's a joke, obviously. You really must get that straight, because all the way through what we come to do when we're actually looking at exchange rate risk, there's clearly going to be lots of converting. And although you don't lose the marks twice, so you wouldn't, picking the wrong rate wouldn't fail the whole question. It does make all the figures you're doing go to pieces. If you're already happy, great. If you're at all unsure, listen to this bit of the lecture again. Look at those examples again. Make sure you've got it. However, that in itself was nothing to do with risk. There we were just converting at today's exchange rate, which we call the spot rate. The problem, as I said earlier in the exam, and in real life, is that, well, look at the second example. If the exchange rate today is that, then if we were paying today, no problem, 22 million. But if it was the same question, but we weren't going to pay for another month, well, of course, in a month's time, the chances of the spot rate being the same are tiny. It will have changed. It may have gone up. If it goes up to 10 rupees to the dollar, we end up paying more. If it goes down, we end up paying less. But here, we're not talking about gaining, losing. The fact that we're not certain whether it's higher or lower, there is risk. And as financial manager, we need to look at ways of removing or reducing the risk. And so, before I pause this lecture, because I said there is a lot, and I'm going to break it down into several. If you look at the next page, there's a list there of different ways we might consider of reducing the risk of exchange rate movements. The first four are really more for discussion and are pretty obvious. Well, sorry, apart from the terms perhaps. The real work is on the last five. But let's just run through. First of all, the most obvious of all is invoice in your home currency. If I'm in the UK buying from America, provided I send my invoices in pounds, I'll receive money in pounds. I'm not worried about changes in exchange rate. It's the customer who's got the problem. The American person has to buy the pounds. No risk at all. Except, of course, if it's a huge customer, we might not be able to invoice in pounds. They may insist in us invoicing in dollars. Perhaps we do that rather than lose the customer, in which case there'd be risk. And of course, when we come to buy goods from America, we can ask them if they'll invoice us in pounds, and if they will invoice us in pounds, no risk. But of course, it's unlikely they'll almost certainly insist on invoicing us in dollars, and therefore we'll have to buy dollars. We're at risk. The next one, leading and lagging. As you'll see, I never really think this reduces risk, but still. Just suppose we owe money, we're in the UK, we owe money, well, we owe dollars. So we're going to have to buy dollars. Suppose I think that the exchange rate will change, that the dollar will become stronger, and therefore the longer I wait before I pay, the more it's going to cost me. I think the exchange rate is going to move against me. Well, if that was the case, surely it would make sense to pay as soon as I can. Let's pay quick before the exchange rate moves against us and it ends up being more expensive. Well, we call that leading. Leading is paying early. Whereas, of course, if I thought the exchange rate was going to go the other way, that it was going to move in my favour, the dollar's getting weaker, then, the longer I can delay payment, the better, because in pounds it'll cost me less and less. Well, that's what lagging is. Lagging is delay payment and as to which you do, well, it depends on which way you think the exchange rate will move. Okay, so fine, there's obvious logic there if you understood me. The reason it doesn't really remove any risk is because, of course, you may expect the exchange rate to move in our favour or to move against us. But, of course, you're never certain. I think the exchange rate will go up. Well, that doesn't mean it will go up. It might go down. There is still risk. However, that's not relevant to you for calculations in the exam. Just something you're expected to be able to mention if it's a discussive question. C is netting. What netting is, and this could be relevant in numbers, you'll see later, but it's very, very obvious numbers. Netting is a very obvious thing. Suppose I told you that we've sold goods to the US, to a customer in the US for $100,000. We're in the UK, and we've been buying goods from the US as well. We bought from the US, and we're going to have to pay out 80,000. And in both cases, it's going to happen in 1 month's time. Well, of course, on their own, they're both risky. In a month's time, when we come to convert to pounds, the receipt, we may receive more or less, depending on the exchange rate. Similarly, the purchase, we're at risk on that 80,000 we're paying. But surely the obvious way of at least reducing the risk would be to net them off. It's completely mad to buy $80,000 and pay that bill, equally to receive 100,000 to sell 100,000 to convert. It'd be daft. Why don't we just use one to pay the other? Effectively net them off. There is a net receipt of the difference. And it's simply that net receipt that we're at risk on. You know, open a foreign currency bank account, open a dollar bank account, use the receipt to make the payment. You're at risk of 20,000, and okay, you'll want to look for ways, which we're coming to later, of reducing or removing the risk on that net 20. So that's actually, it's something for discussion, but it's also quite common in the exam as the first step. They might give you a whole list of receipts and payments, some in 1 month's time, some in 3 months' time, and so on. Well, if you've got several in 1 month's time, net them off. What's the net amount at risk? If you've got several in 3 months' time, net them off. What's the net amount at risk in 3 months' time? And then later, we'll look at reducing, removing the risk on that net amount. Companies do it globally. You know, we might be a group of 20 companies in different countries, and they're all making payments and receipts in dollars, payments and receipts in euros, in all sorts of transactions. Well, it's quite common in that situation to have a group treasurer who effectively is netting off as though it was one big company, that have all the companies in the group. Let's look at all the dollar transactions, and instead of converting each one separately, let's simply convert the net amount. Anyway, finally, these first ones, D, matching, which again is really only for discussion, and is rather different. Some people confuse it with netting, but it isn't. It's rather different, this. Just suppose I'm in the UK, I say this is rather different, but suppose I tell you I do make some sales abroad. Well, most of mine are in the UK, but I do make some sales abroad, and it's approximately sales to the US, let's say about 100,000 a year. And so, of course, that revenue each year is subject to risk, because even if it stays at $100,000, year by year, clearly as the exchange rate goes up or down, the pound income will change. There's risk. Well, what would be rather neat is this. Suppose I deliberately create an expense of, in an ideal world, $100,000 a year. How can I do that? My expenses, I'm an English company, my expenses are in pounds. Well, perhaps deliberately, I buy some of my materials from America instead of buying from the UK. So deliberately, I've got an expense in dollars. Or perhaps I am going to borrow money. For whatever reason, I'm borrowing money. I'm going to borrow money anyway. Normally, I would borrow money in pounds, obviously. I'm in the UK, and I pay interest in pounds. Well, perhaps I deliberately borrow money in dollars. So I'm bound to pay the interest in dollars. And why would I do that? Well, the beauty of it is that if I manage to match those exactly, then as exchange rates change, the dollar income goes up and down. But at the same time, as exchange rate changes, my expense when I convert goes up and down as well. So they go up and down together. Less pound income, less pound expense, more income, more expense. The risk of one cancels the risk of the other. Now, obviously, it's not too difficult to match the exact amount to be perfect, but it's something that might be worth considering. Again, though, not for calculations there. It's just something you could mention if it's a discussive question. However, where the real work comes, and what the following lectures are going to go through in detail, is what you might call the special techniques, calculations for the exam. You've got to be able to cope with what we call forward contracts, money market hedging, currency futures, currency options, currency swaps, all different ways involving arithmetic, different ways of going about reducing or removing the risk of this transaction. The transaction risk, the risk of exchange rates changing. The first two, possibly three of those, you should have heard of in the previous financial management exam, but they're asked again in this exam quite regularly. If ever there's a foreign exchange risk question in the exam, which there very often is, I've already said, then you're likely to need all five of those. But certainly in the same question, you can expect to deal with 3 or 4 of those methods. So in the next lecture, I'll start going through them one by one. Some are pretty quick, and first 2 certainly should be revision. They then start getting rather more complicated.